and now we can move on to learning objective 2, which is cash management. Here, let's watch for some normal culprits when we get in trouble. Too much money tied up in inventory, because it's sitting there in inventory. You paid cash or will to get it there. So we want to decrease the amount of inventory, which has the measure of increasing inventory turnover. Next, we want to move cash in faster. So we want to either have more cash sales, which is best, of course, but if we do sell in credit, which is a business reality, let's collect it fast. If they say they'll pay in 30, let's make sure they do pay in 30. And so tell them this is the terms we operate. If you pay in 30, great. If you're late, unfortunately, we're not your bank, and we have to charge you a late fee. Something like that, just to make sure you keep the cash rolling in. Third is cash out slower, which means negotiate for terms or pay right to the edge of when it's due. Let's try not to be late with payments, but let's not pay too early either. And the last but not least scenario is if we're short on money, we need financing. So the financing can come in the form of debt, which is borrowing, or equity by way of selling stock, whether it's common or preferred stock. So there's some ratios in this section that we could use to diagnose our health and where our health or lack of health is coming from. So this is just describing the operating cycle of a business. We have cash, we buy materials and work in process, we now have finished goods, we sell it, we collect it, we pay our bills. So let's go back to our friend, the cash conversion cycle, which we looked at in the prior exercise, but now we'll look at it from a different vantage point on how we could use it looking forward. So here we're going to create a little model in Excel, and this is in PowerPoint, so I'm going to hop out again into Excel and go to cash conversion. So I copy the data all along here. So this is just data, and notice that this section here represents balance sheet. So put those in blue, and notice these represent the income statement. All right, so in the case of a balance sheet, we use averages. In the case of the income statement, we do not. We just use the month itself. All right, so that's just an observation. If you set up the top section this way, it's going to be easier for you to do the calculation. Now, each of these boxes represent one of the calculations. So here we have inventory to sales, which is days in inventory. Here we have days to cash collection, which is days sales in receivables. And this is our purchase to payment, which is days payable outstanding. So these are the three pieces we need for the cash conversion cycle. The calculation for days in inventory is average inventory divided by average daily sales. So here, average inventory is computed here. Average is the halfway point between 95 and 140. The day sales represents total sales divided by 365, and the days in inventory is simply dividing average inventory by the average cost of goods sold, and we get 112 days. Not particularly comforting. It takes over 3 months to sell our inventory. 30 days with 3 months times 30 is 90. So that is 112 is more than 3 months and bordering on 4 months. Next, let's look at day sales and receivables. Here's the formula. Average receivables divided by average daily sales. Average receivables, again, here is halfway between beginning and ending receivables. The daily sales is total sales of 575 divided by 365, or 1,575 per month. So if we have 90 outstanding, and if we have daily sales of that, our days sales receivables is 57. Again, not very impressive. It takes almost 2 months to collect our money. Finally, paying our bills. Average accounts payable divided by average COGS. And here, the book's definition is average accounts payable and accrued liabilities, with the assumption that the accrued liabilities are all operating expenses. Not a bad assumption. So here, our average AP and accrued liabilities is a sum of 70 and 9,500, and our daily cost of goods sold, as we've seen before, is 380 divided by 365. So the days payable outstanding 76. So that's also a little bit worrisome because most vendors want to be paid in 30 days and we're taking 76. We're taking somewhere between 2 and 3 months to pay our bills. that likely would cause some consternation from our vendors. But let's just take that as fact for now and go from there. So now we're ready to compute the cash conversion cycle. So this particular item, take the days in inventory plus the days in receivables minus the days payable outstanding. So 112 is inventory, 57 is receivables, and 76 is days payable outstanding. So the CCC, or cash conversion cycle, equals 112 plus 57 minus 76, or 93. So how do we interpret that? It takes us 93 days to go through one full circle of getting inventory, selling inventory, collecting the money, and paying our bills. It's a little bit long, just in absolute terms, so we want to be a little bit vigilant on whether we can make that go down or not. We would like it to go down by quite a bit. All right, so that's the calculation of cash conversion cycle and the format, which makes it easy to simulate changes. So we did this way instead of just shortcuts, so that we can work with scenarios going forward, like what would happen if we're able to lower inventory? What would happen if we are able to collect faster from our customers? So that's the purpose of this exercise. And here we have just an example analytically. If we have two periods of time, 2015 and 16, and we have these results, we look at what happened between 2015 and 16, we see that the inventory to sales went up, which is not good. That's unfavorable. We see sales to cash went up. That's also not good. We should be collecting faster, not slower. And the purchase payment went down slightly, which is, I guess, good. We're paying a little bit faster, but by 1 day. That's not exactly significant. So the cash conversion cycle deteriorated from 84 to 93. So went up 8 days. Not good. So if you would say, what are the levers we have to control things? One of the hints is that every factor and every variable is a lever. So let's look at the first one. Inventory to sales. Can we reduce our inventory, or can we increase sales without increasing inventory? That would make this ratio improve. Second, can we collect faster our receivables? And by doing so, we'll lower this number, which will lower our cash conversion cycle. Purchase payment, I'd be a little leery on this one. Can we get favorable terms for our vendors so they let us pay them in, say, 60 or 90 days? If they do not let us, let's not be reckless with our payment to them. So let's try to pay them so that we can maintain positive vendor relationships. So those are the levers we have to work with. In this case, more of it's on the asset side than on the liability side. So summarizing chapter 6, if you want to survive, you better manage cash. We can start by looking at cash budgeting and look at the economics of the business and try to capture that inside of our projections, sales projections, inventory projections, our other operating and capital costs to run the business. And then we have certain ways of looking at things. Let's collect cash faster. Let's pay cash slower. And if we need to raise money, let's raise money before we need it so we don't get ourselves in a liquidity crisis. And finally, we can use some ratios to monitor where we are and perhaps point to actions that could improve our financial performance. All right, that's it for chapter 6, and I will see you in class.